Coming up on today's program, this year's most surprising ETF standouts, plus runaway government debt, and how US Treasury bears have been cleaning house, plus safety tips, all of that and more. Let's get right to it with your big picture view of financial markets through the lens of ETFs, beginning with the standout leader this year has been commodities, which have gained over 33% since the start of the year. Ticker symbol STCI, which tracks a basket of different commodities. And we did a poll. I forgot to post it in this particular presentation, but the poll, I was actually shocked by the numbers. The vast majority of those responding, I think it was like over 75%, said they had no exposure to commodities inside their portfolio. Well, we talk about SDCI all the time on this channel, and it's a great plug-and-play solution for getting easy access to commodities and diversifying your portfolio. So that particular ETF, though, like I said, has gained 33% and change. Just behind it, we've got S&P 500 up about 14.5%, and then REITs also doing good. This is global REITs. Global real estate ahead by just over 14%. And then bonds are pretty much flat. And then IBIT, which tracks Bitcoin, it's been a rough stretch for cryptocurrencies this year. And like I've said before, unless we see, I think, let's just put it this way, some sort of a liquidity event or crisis with some of these debt-driven organizations like Strategy, until we see those companies wiped out, I don't think we're going to see any significant bottom or meaningful bottom in cryptocurrencies. Once we have that happen and some of these companies get flushed down the toilet, then I think we will see a firm bottom, a scary moment in cryptocurrencies, and that could represent a good buying opportunity. We talked about SDCI earlier. It's a 5-star rated fund, and I continue to harp on it. Those of you that don't have exposure to commodities, take a look at SDCI. Now, another area in the commodities space is SETM, which focuses on critical materials. This particular ETF, as you see over the past year, has smoked the S&P 500. It's gained almost 59% compared to a 21.5% gain for the S&P 500 over that time frame. And SETM really offers a nice balanced approach to critical materials, things like lithium, things like nickel and copper and rare earths and uranium, all in one ETF ticker, so that you can avoid that single metal bet risk that sometimes happens. And it's really a great ETF and ticker to keep on your list. And again, check out our latest Metals in Motion episode. We just released it a couple days ago right here on this channel. I got the link in the description section below. And that particular episode takes a deep dive into SETM and what's been driving those results. In terms of S&P 500, we've got 11 industry groups. 9 are up, 2 are down. Bulls are still in control. The industry groups that are down modestly. Communication services, and then consumer discretionary stocks. Again, these are modest losses, and the bulls are really in control. We see almost half of those industry groups up double digits, led by energy, technology, and industrials. That's where the most bullish action has been to the upside. In terms of another area that we've talked about on the channel, we're going to be discussing more in our upcoming ETF Battles episode. We've got Dave Krinsis, one of the proponents of leveraged ETFs, and Dave is going to go a little bit more into some of his favorite leverage ETFs. But I wanted to point out TECL, also known as TECL. It's delivered one of the most astonishing long-term runs in the entire ETF universe. Look at this chart. This is like the Mona Lisa of charts. If you're into charts, and even if you're not, it's like the Mona Lisa. You could see from this chart over the past 15 years, TECL has surged. Are you sitting down? Over 27,428%. Now, How does that compare to some of the great stocks of our era? Tesla, over that same time frame, gained only 19,413%. Apple rose only 2,600%. Amazon rose only 2,500%. Teckle gained 27,428% over a 15-year time frame. Just extraordinary. Now, mind you, it also experienced multiple drawdowns exceeding 75% over that same time frame. So pretty puke-worthy results along the way, and probably you lost your stomach. For those of you that held on, not many, but those that managed to stay the course, even despite those 75% plus drawdowns, the upside has been extraordinary. So Teckle, put that one on your list. TMV, let's talk about this one. At the outset, we talked about runaway U.S. government debt, eroding faith in government bonds, and this is illustrative of what we see. This is a 2-year chart. You see TMV, which is a 3x bearish ETF, 3x daily on long-term U.S. Treasuries. That's with 20-plus year expirations. We can see that TMV's gained over 57% over the past 2 years. TLT, which is just straight performance unleveraged to long-term U.S. Treasuries, has lost value around 8% over that time frame. So TMV has been a winning trade. It's really picked up here over the past month. It has really soared and jumped. And I think more upside is ahead for TMV. And just that whole bearish Treasury trade, I think, has legs from a tactical perspective. U.S. government debt just crossed $40 trillion, and it's unsustainable. It is unsustainable. This chart shows you that it is just out of control. It's not going to get any better. And as far as trust in government, this was a research piece by Aswath Damarin, professor over there at NYU, one of the best. And he explained that there is a lack of trust and faith in governments anymore. And it really kicked off during the 2008 financial crisis. This is what he had to say in part. The notion that the U.S. or U.K. governments would default on their debt would have been unthinkable. But the 2008 crisis, in addition to the financial damage it created, also opened up a trust deficit. And this is what he says, and I agree with this. I have argued that this trust deficit not only gave rise to the crypto boom and to political upheaval, but has also made the unthinkable a reality. In fact, you would be hard-pressed to find any government that is trusted the way it was prior to the crisis, and that loss of trust also implies that the clock is ticking towards expiration for the government bonds are risk-free argument. I mean, how many times have we heard that nonsense? Government bonds are risk-free. No, they're not. No, they're not. Stop that nonsense. All the textbooks were wrong. And you would never use government bonds in your safety bucket, and you should not use them. More on that in a second. Continuing this thought of runaway government spending, this takes a look at the presidencies. You can see since the Obama era forward to now, there's been a massive uptick in runaway government spending and debt added. Now, just with the Trump administration, or I should say Trump presidency, if we just look at his first term, U.S. national debt increased by $7.8 trillion. During the second term, which we're about halfway through, debt has already climbed over $3 trillion thus far. So altogether, Trump has overseen roughly almost $11 trillion in added debt across both terms so far to date. That's per the U.S. debt clock. Now, this is not a political statement for or against one political party or the other. Ron's view on this is that both political parties are at fault for runaway government debt. Some presidents are worse than others. But let's not get lost in who's at fault, which president's more at fault versus this or that. they're both across both aisles at fault equally. And the problem here is that the government's heading for fiscal reckoning day, and U.S. income tax rates are going to skyrocket. And they're going to skyrocket for everybody, not just the billionaires, but everybody, especially the middle class. And that's what's coming. You're not going to be in a lower tax bracket in retirement. Most of you are not going to be. I know that's another fallacy that we were told, right? You're going to be in a lower tax bracket in retirement because you're earning less money. You could take all of that and throw that in the garbage because it's not true, and it's not going to be true for millions of investors and retirees going forward. My generation, Generation X, you can throw all that stuff out of the garbage. If your retirement plan tells you you're going to be in a lower tax bracket in retirement, you need a new retirement plan. So that's the reality. I know it's probably stuff that you don't want to hear on the weekend, especially a summer weekend, but I'm just trying to tell you like it is so that you could be ready. Now, let's talk about the safety bucket. There's three cornerstones of a well-built portfolio. You've got your safety bucket, your core, and your non-core. Why would you ever use an asset like US Treasuries that has interest rate risk, that fluctuates on a daily basis, can and does lose value on a daily basis, right? That previous chart I showed you, you see long-term US Treasuries have lost value over the past 2 years. So that's not the type of asset we would ever use inside a safety bucket. Safety bucket are assets that protect your principal, that guarantee your principal, that don't have fluctuations, no volatility, and no potential for any loss. And of course, you want liquidity. Those are the attributes of the types of investments and assets that meet minimum safety standards. And so if you're going to use long-term U.S. Treasuries or bonds of any sort, this is not an anti-bond or anti-Treasuries, although it seems that way. The only place you would use those in the context of an investment portfolio would be in your core or non-core buckets. Never, ever in your safety bucket. And so that's the main lesson here. Hopefully you're getting that to your brain. Now, one last thing before we take off for today, because we've covered a lot. Let's talk about your safety cushion for a second, right? Because many of you have not implemented a safety cushion inside your investment portfolio. And by the way, right now is the optimal time to do it. Why do I say that? Because markets are rising, and conceivably your investment portfolio has risen alongside markets, and that means that you're able to protect or insure even more of your portfolio because of rising markets. So the internal conditions are what we can control internally. And the time to implement your safety cushion, there's only 3 internal conditions that we can control. We could do it now, we could do it later, or we could do it never. Those are your 3 choices. External conditions we can't control. We cannot control rising markets. We can't control falling markets. We can't control neutral markets, right? We have no control over the external, but we can control the internal. But you see, the result is different depending on the market. And right now, as you can see, the most optimal time to implement your safety cushion is when markets are friendly, when markets are rising, because we can insure or protect more of our investment portfolio. When markets are crashing or markets are declining, presumably our portfolio is also declining, or at least to some degree. Now, that means that we can insure or protect less of our portfolio because it's gone down in value. And then in neutral markets, same idea. Semi-optimal because, well, markets are choppy. So our portfolio is likely to follow that sort of a trajectory. So again, take advantage of friendly markets right now. If you did not join our August cohort, we did the Portfolio Safety Challenge. I will be doing one in September. So more on that. I'll be making an announcement soon. And we'll also be doing a webinar all about protecting your retirement portfolio. We did this as a general public service announcement in July. We're going to do another one, but specifically targeting those of you that are nearing retirement or already retired. So stay tuned for that. Our Bloomberg Billionaires Index, this is the big money. What is the big money doing? Well, and how did the big money get that way? Well, you'll notice that the top 9 out of the top 10 billionaires made their fortune in the technology sector. And from an investment perspective, that's, I think, a great lesson for investors. That's how to allocate your money. That's where to allocate your capital is in the technology sector, and to have exposure to that. And there's lots of ETFs and lots of different strategies to do that. We highlighted tech on today's program. That's not the only one. There's a lot of others. XLK, of course, semiconductors. We didn't even talk about Soxal. That's been another ETF that's been bananas in terms of explosive upside performance. Soxal, SOXL, from Direction. So again, the technology sector is where most of the wealth is concentrated. That's not going to change anytime in the future in terms of just society and the globe becoming more digitized. Of course, the invention of AI, the expansion of AI, and all of the data centers required to support